Good morning, good afternoon, good evening, wherever you are. I'm your host, FD465.tv, and in this video, we want to look at something that is causing a lot of disgruntledness, a lot of upset for people who think we are now in a bear market and people are upset. No one wants to believe that. I do not believe that. I still think this is just a cool down during a bull market. But for those who are strong believers in Bitcoin 4-year cycle, they honestly believe the bull market is peaked. But who is right? Those who believe the 4-year cycle or those who believe the global liquidity cycle? I'm sure the truth is somewhere in between. But before I jump into this video, guys, please know that I am not a financial advisor. Please do your own research. Do not take what I'm sharing with you in this video as financial advice. The content in this video is just for educational as well as entertainment purposes. And this content is not for UK audiences. Please do not watch any crypto related content. Let's come back to the misalignment or the disagreement between the two camps, the 4-year cycle believers, that is Bitcoin 4-year cycle, and the global liquidity cycle. Who is right? Let's jump in. Let's start with Bitcoin 4-year cycle. As a result of its protocol, Bitcoin undergoes a halving roughly every 210,000 blocks or every 4 years, where the miner rewards are cut in half. This is the structural trigger for what many call the 4-year cycle. Historically, periods between halvings appear to show phases, accumulation, bull market, and blow off top, but we didn't get that this year. And what follows the blow off top is the bear market, where you get a bottom and the cycle repeats. For example, halving in 2012, bull run into 2023, halving in 2016, bull run into 2017, halving in 2020, bull run into 2021. So if that was to hold true for this current cycle, halving in 2024, bull run in 2025. So this confirms that those who believe in the 4-year cycle, they may be right. But are they? Let's look at the global liquidity cycle. The global liquidity cycle refers to macroeconomic conditions where central bank policy, money supply, for example, M2 money supply, credit expansion and contraction, risk appetite across global markets. Analysts argue that Bitcoin's major turning points often align with liquidity expansions or contractions. For example, global M2 growth bottoms aligning with Bitcoin bottom. Thus, some contend that liquidity, not just halving, is the true driver of Bitcoin's major moves. Let's review past cycles with some evidence. Let's look at cycle 1 in 2012, where we had 2012 halving and peak in 2013. The halving happened in November in 2012 and bull run accelerated into 2013, peaked around late 2013. We can link this to fairly loose global liquidity environment pre-2014 until global tightening, though data is sparser. Cycle 2 in 2016 halving into 2017 peak. Halving was in July 2016, peak was in December 2017. Global liquidity was still relatively expansive post 2008 easing. After the peak 2018 bear market, global tightening strategies increased risk. Bitcoin collapsed 80%. On to cycle 3, 2020 halving and the 2020 peak. Halving was in May 2020, bull peaked in November 21. This period coincided with massive global monetary and liquidity expansion. Central banks printing near zero interest rates, fiscal stimulus from COVID responses. This strongly supports the liquidity-driven argument. Liquidity surge is equal to favorable conditions for risk assets such as Bitcoin and other cryptocurrencies. Now on to cycle 4, 2024 halving, and the peak, as some are already calling it, was in October of 2025. Is that true? Current cycle is still unfolding in my view. Analysts note divergence. Liquidity conditions are different. For example, inflation, Fed policy, and institutions are more prominent. Some say the classic 4-year cycle rhythm may break or be strange because macro and institutional dynamics play a stronger role now than the Bitcoin 4-year cycle. Arguments for the 4-year cycle being independent of everything else. The halving event is protocol embedded, predictable, and reduces new supply, talking of block rewards, which arguably creates a supply shock that should independently drive price. Historically, each halving has been followed with time lag by a strong price run, which suggests structural cause beyond macro. The psychology of market participants anticipating halving, build-up, and speculation seems to repeat in a roughly 4-year rhythm: accumulation, breakout, blow-off, and bear. Some modeling, for example, halving-driven supply shock model, argue the 4-year cycle is built in. So that is the case for those who believe in the 4-year cycle. Let's move on to the opposing argument then for global liquidity supply. Several analyses show key Bitcoin bottoms and turns align with global M2 supply or other liquidity troughs. For example, liquidity bottom in 2015, 2018 coincided with Bitcoin bear bottoms. In the current cycle, 2024 into 2025, factors such as institutional flows, ETFs, macro real yields, liquidity expansion are playing big roles. Some analysts suggest the classic 4-year cycle might be losing efficacy due to these new dynamics. If liquidity dries up, even halving may not trigger major bull run. Supply shock alone may not overcome weak demand. Commentators like Arthur Hayes these argue that the 4-year cycle is dead and liquidity is now the dominant driver. My own assessment is this. I hold a hybrid view. The Bitcoin 4-year cycle, including the halving, is a real thing, but it is conditioned by and not independent of the global liquidity cycle. So what am I saying here? In other words, I'm saying the halving provides a structural anchor on the supply side that helps explain recurring rhythm. But on the demand side, especially global liquidity and macro flows, these modulate the magnitude, timing, and duration of its cycle. In early Bitcoin years, liquidity effects were less distinct and the halving signal dominated. As the market matured, you're talking about from 2020 onwards, liquidity, institutional flows, ETFs, and regulations began to matter more. Therefore, while the 4-year cycle remains a useful heuristic, relying on it alone ignores the crucial context of global liquidity. And here are some of the implications of ignoring that. Expect variation in cycle length and the amplitude. The next cycle may last longer or peak later than previous ones if liquidity conditions are muted. For investors like myself, we should be watching out for both halving timelines and macro liquidity indicators. We're talking about money supply, real yields, and institutional flows. If liquidity remains ample, the halving supply shock may lead to strong price run-up. If liquidity tightens, the halving may produce a muted effect or longer consolidation. Finally, what I would like to urge you guys, those who hold one end of the spectrum or the other, Bitcoin 4-year cycle or the macro liquidity cycle. Think of the 4-year cycle as Bitcoin's metronome. It ticks every 4 years via halving and sets a beat. But the orchestra playing the music is the global liquidity environment. Just because the metronome ticks doesn't guarantee the siphoning will roll. The musicians, that is liquidity, institutions, demand, must still play whether you've got your halving or not. So in short, the halving cycle is real, but it doesn't act alone. If you bet solely on the calendar, you might miss the tune. The real key is check the beat and listen for whether the orchestra is warming up. If you are not combining the two, like my hybrid approach, you may actually miss the rest of the bull cycle. After all, only a short period does determine who actually makes the most money. If you look at what we've just experienced, that supports my thesis. What are your thoughts, guys? Let me know in the comment section. Until the next one, FD for 65.TV signing out for now. Bye.